Thank you, Chairman. Last month, in a hearing before the committee about due process issues with FSOC, Professor Jonathan Macy of Yale Law School stated that with respect to the actions that the FSOC have already taken, there is a significant danger of increasing rather than decreasing systemic risk. And his point, as he explained, was that this was because the FSOC is ignoring certain risk mitigation strategies and herding entities into particular risk strategies, which decreases diversification and then increases the systemic risk. This could also happen indirectly, with companies making choices to merge, sharing in the costs of compliance, and creating greater economies of scale. We've seen this in the banking sector, or more directly with the implied or explicit backing of the government, as in the case with the GSEs. So I was going to ask Mr. Curry, do you view the potential for regulators to create systemic risk as a problem, and what actions have you taken to make sure that, and I'll also ask this of Chair Matz, that the FSOC's designations and enhanced prudential standards of the Fed are not increasing systemic risk per the thesis that the Yale professor puts forward?
Congressman, the FSOC actually is looking at, and this is referenced in our annual report, looking at some of the consequences of changes within the marketplace, including regulatory changes. There are behaviors that have changed. Institutions have either left or entered different types of business, not the impact of non-banks. Those are all things that we've identified as emerging or potential emerging risks that require further monitoring and, if necessary, potential action down the road.
And Chair Matz, if you could just weigh in there.
Thank you. More specifically, as the designation is being considered, the company has an opportunity to present any evidence to the staff, whether in person or in writing. And so if they think that there might be information that would be helpful in making the in determining whether to designate, they have every opportunity to make that information available to us.
And lastly, I'll just ask Chair White, do you agree that this is a problem? Would you like to weigh in on your
Well, I think it's certainly something that I think we need to be constantly keeping in mind with all of our regulations, what impacts they're having, what mitigators we ought to be considering in addition.
Okay. Now, I'm trying to better understand how the interaction on another subject here between the Office of Financial Research and FSOC members works. After criticism by this committee and the public on an OFR report regarding the asset management industry, the FSOC sought public views on the industry and later issued a request for notice and comment on asset management products and activities. Separately, the SEC put out the OFR report for public comment. Can I ask the panel, do any of you see a reason why all OFR public reports should not be open to public notice and comment? Does anyone take exception to that concept? For the record, Mr. Chairman, I'd like to say that the witnesses, for the record, saw no reason to continue the practice of OFR not allowing for public comment on their reports. That's the point I wanted to make. I think it's important that they do so. And if I have time here, the FSOC has not designated any asset managers as SIFIs, which is a step I support, as these firms operate with little leverage, if any, and the risks they manage are borne by those whose funds they invest. But the FSOC is now apparently considering the industry under activities-based regulation, the second prong of Section 113 of the Dodd-Frank Act, rather than material financial distress, the first prong. My question is not about asset managers, but rather how FSOC came to this decision and why a similar process wasn't used when designating insurance companies. Mr. Woodall, is it fair for the FSOC to offer different amounts of process to different industries, and why not take the same amount of time and get it right?
Well, Congressman, I think that we've already discussed the fact that in activities, which has been my main goal in the insurance company, it's evolving now in the council. The council is young, it's evolving, and I welcome the idea of taking a pause and getting into looking at the activities across the segment. And I hope that they will do that for the insurance industry too.
Thank you, Mr. Chairman. Thank you, Mr. Woodall.
Time of the gentleman.